Welcome to Daily Dose of Dividends. Today we're going to take a look at the top 5 dividend stocks that we evaluated last month. That might be a good pickup now for June. So let's get right into it. First one is Syntas with a market cap of $37 billion in the specialty business service industry. It has appreciated quite well, the stock price, and is now in a fair value. On the scorecard it got 9 out of 10 points, which is really good. It only falls a bit short on the dividend yield. It has a really nice dividend growth rate of 23% and a massive 37 years of dividend increases. Really nice. Next up is United Health Group with a massive market cap of $468 billion. Also 9 out of 10 points. Same here, it falls a bit short on the dividend yield, 1.16% only. But the payout ratio is quite low and the growth rate is also amazing. It's quite hard for the dividend yield to keep up when the share price keeps rising like this. So it's no wonder it is not higher than this. Next up, we have WilliamsSonoma with a market cap of $8.6 billion. It has quite a spiky track record for its share price. Also 9 out of 10 points. This one actually has quite okay dividend yield of 2.5% and fairly low payout ratio of only 17.4%. Also a nice growth rate, but it might be a bit more harsh in the future regarding its earnings, so that is why the stock price is coming down. And we can see retail having to struggle a bit lately, so yeah, be a bit careful with WilliamsSonoma, but we're gonna take a look at the valuation further on. So on to the next one, and that is UPS. Has a market cap of $155 billion and also a score of 9 out of 10 points. It has actually started its share buybacks program again, but over a 5-year period the outstanding stocks has actually increased. It has a really nice return on capital and a massive earnings growth of 30.6%. So yeah, the freight companies are really making tons of money right now with the increased blooming e-commerce. Very nice dividend yield, very nice payout ratio, and a fairly mediocre growth rate. But it has actually been paying the dividends for 22 years. Well, increased its dividends for 22 years. The next one up is Visa with a market cap of $436 billion in the financial services industry. And sometimes it can get hard to get Visa at a fair price, but now might be the time. It actually has a score of 9 out of 10 also. And same here, it falls a bit short on the dividend yield. But other than that, it's just great numbers all over the field. Nice sales growth, nice earnings growth, massive return of invested capital, low debt, and yeah, overall Visa just looks amazing. I think we're gonna take a look also in Fastgraph to check the current valuation of these companies. So if we jump over here, we can see, to start with, Syntas. If we look at the max amount of years, we can see it has actually a fairly steady growth. It's not doing great in recessions, but during 2020 it actually stood up quite well. If we take a look at the 10-year projected earnings, and we can see it's trading quite high. The blue line is its normal valuation, and we can see it's quite high right now. It's 27.6 PE. And if we project forward to 2024, we can see it projects to a total annual return rate of only 2.6%. So for Syntas, it probably needs to come down a bit. It's trading quite high above its normal valuation right now. So next up is United Health Group. If we zoom out on United Health Group, we can see it's just performing incredibly. It's not very often we see consistent and accelerating growth like this. If we go to the performance tab and compare to the S&P 500, we can see if we go to, for example, a 15-year period, you can see the S&P performed 12%, while United Health Group performed almost 26% per year. That's crazy. So, how is the valuation right now? It's actually incredibly high. This probably needs to come down quite a bit for it to be a deal. Right now it's trading almost at $500, but for it to be a good buy, we can look at the 10-year period. You probably need it somewhere, at 400 or below 400 to be a good deal. But as it keeps raising its earnings, you can actually buy this at a quite premium and still make a decent return. Here it's projected to make a return of 6.3% annually if it's gonna trade at its normal PE, which is the blue line. So still, I wouldn't jump into United Health Group right now, but maybe at the 400 price range, this stock starts to get interesting. Next up, we have UPS. If we zoom out on UPS, we can see it's quite steadily earnings, but not doing great at all in recessions. But overall, it has come down quite a lot in price, and it projects to keep on tracking, literally. So if we zoom to a 10-year period, we can see that if it's gonna trade at its normal valuation, we actually have a nice total annual return rate of 20.6%, which is quite amazing. And the freight companies like UPS, FedEx, and so on seems to do great so far. There's always the threat of, for example, Amazon shipping its own via its own services, but I think still UPS is gonna have a nice time forecasted for them. Next up, we have Visa, and if we zoom out on the Visa, we can see it's just extremely steady. And if you pay attention on the right side here, you can see that this earnings is growing with almost 22%, which is crazy numbers. It's basically double up the S&P 500. And the stock price usually, as we can see here, follows the earnings curve. So if we go to the performance, it should have, basically it's more than double up the S&P 500 in returns during this period. So how does the forecasting look? We can see that the stock price has come down a bit. It was up almost on 250 and now it's at 207. And the future seems to look bright, at least the analysts think so. So if these stocks keep trading at its normal valuation, which is actually quite high, so for a quality company like Visa, you will actually pay a premium of 31 price to earnings. But if it keeps going like this, you will look at the annual return rate of 19%, which is great. So yeah, it's forecasted to keep doubling up the S&P. So if you not have Visa in your portfolio, you might want to take a look at it. You might be shrugged off of the low dividend yield, but yeah, they are raising it like crazy. And if you're long-term investor, and especially in your younger years, this might be a very good play. And last but actually maybe least, the smallest company here, WilliamsSonoma. They had, of course, quite a spike during the peak of the disease. Everybody was buying furniture for their home, which also became their maybe office. But if we zoom out a bit, we can see that WilliamsSonoma is actually can be a risky play because it tends to not do very great in recessions. It was literally up at 44 down to 4 during the 2008 crisis. So I would be a bit careful with WilliamsSonoma, but it has come down quite a lot in price. But yeah, I'm a bit hesitant on the projected earnings for this one, and I think the stock price is coming down by a reason here. So don't do like many did with Alibaba, tried catching a falling knife. I would probably wait a bit to see if it could maybe rebound a bit before buying into this one. And but yeah, still the valuation looks quite tempting. So if we go to a 10-year period, we can see that if you trust the analysts on this one, you can actually have a massive total annually return rate of 36%. So WilliamsSonoma might be worth a small almost dice roll / bet. Because yeah, this one could pay off big time if you're willing to take a bit of a risk. That was all for this time, and hope you liked the analyst last month and these top 5 stocks. If you have other top 5s that you think we missed out this time, please comment below and we can take a look at further videos. See you guys and have a nice one. Bye.